You're walking into a pitch meeting and discovering you already have a committed investor. They don't take board seats, they don't call you at midnight, and they never ask for a discount code. They're invisible most of the year, but they show up every time you buy gear, pay engineers, cover health insurance, or train staff, and they quietly pay part of the bill. That investor is your government, and the money they put in shows up as deductions and credits that reduce your taxes. Start with the simplest truth in business finance. A dollar you don't pay in tax is a dollar of pure profit. You don't have to ship it, service it, or support it. If your operating margin is 20%, you must generate $5 of new revenue to equal $1 of tax saved. That's why the very best operators treat tax as a profit center. They're not gaming anything. They're collecting the contribution their silent partner already promised. Let's walk the factory floor where those contributions appear. The first stop is equipment. Whenever you buy something durable for the business, computers, cameras, vehicles, machinery, your partner offers to reimburse you over time through depreciation, or sometimes immediately through special expensing. In practice, that means a portion of the purchase price reduces your taxable profit now or across the asset's useful life. You can choose fast relief or slower, steadier relief, depending on cash flow and the rules in your country. If you expect a banner year, front-loading deductions can drop your effective tax rate and turn a lumpy year into a smoother one. If next year's rate will be higher, stretching depreciation can be smarter. This isn't just accounting theory, it's how your silent partner shares the cost of growth. The only trap is sloppy paperwork. Keep invoices that show the model, serial number, and in-service date. Keep the financing documents if you financed it, and keep a simple written capitalization policy so your team knows what gets expensed immediately and what gets depreciated. When you sell or retire an asset, record the date and price so you can reconcile the deduction you already took with any gain or loss at exit. You are not trying to memorize rules. You're building a small file that proves the promise was earned. Now walk upstairs to the engineering floor. If you're doing real research and development, designing new products, improving processes, building software that involves technical uncertainty, your silent partner offers credits, not just deductions. A deduction reduces the income being taxed. A credit reduces the tax itself, dollar for dollar. That difference is enormous. To qualify, you need substance, not slogans. Track what you're trying to make better, why the outcome wasn't obvious at the start, the alternatives you tested, and who did the work. Keep sprint notes, prototypes, tickets, test matrices, and the payroll or contractor time you charge to those efforts. The goal is not a glossy binder. It's a short, truthful trail that shows this was genuine development, not routine maintenance. Small companies often discover that salaries for technical staff, contractor invoices tied to the project, and certain supplies form the core of the credit base. Larger ones layer in cloud spend and testing. Done right, your partner literally pays a slice of your engineer's time. Done sloppily, it's just a nice story that doesn't make it past a review. Build the habit now. When you kick off an initiative with uncertainty, give it a code name, set a hypothesis, and tag the time. At year end, those breadcrumbs turn into credit dollars. Step into the benefits office. Health insurance looks like a cost sink, but your partner subsidizes it in two ways. If you're self-employed, you may deduct eligible premiums, lowering your taxable income, even if you don't itemize. If you run a company and pay for employee coverage, those premiums are generally deductible to the business. In some jurisdictions, small employers that contribute toward employee plans can also qualify for a distinct healthcare tax credit, but it comes with rules on average wages, contribution percentages, and the type of plan. The pattern repeats everywhere in tax. The money is real if the facts are real. Keep broker invoices, payroll records showing pre-tax employee contributions, and plan documents that prove eligibility. If your team is too small for a group plan or spread across states and countries, reimbursement arrangements that comply with local law can unlock similar subsidy, but only if the paperwork is exact. Your silent partner will help. Just don't improvise the benefit structure and hope for the best. Training and upskilling deserve a spotlight because they're the cheapest growth lever most founders ignore. Ordinary training to keep skills sharp is usually deductible as you incur it. Certain jurisdictions go further with credits for certified apprenticeships, targeted worker groups, or specific skill programs. If you're paying for courses, certifications, or structured apprenticeships, your partner is often willing to cover a slice. The trick is to name the program, keep the invoice, keep the completion proof, and line it up with payroll or assignment records that show who benefited. A year later, when someone asks what that learning lab expense was, you can show the exact people who leveled up and the tax relief that followed. Now look at energy and infrastructure. Governments want cleaner, more efficient businesses, and they say so with tax code. If you install qualifying HVAC, heat pumps, insulation, lighting, or solar on your building or facility, you may be eligible for credits that reduce tax rather than just deducting the cost. Vehicles are in play too, subject to weight, usage, and emissions thresholds. The rhythm is the same. Review eligibility before you sign the vendor contract, make sure the equipment meets the specification, collect the manufacturer certifications, and keep the commissioning paperwork. Done in the right order, your silent partner pays for a slice of the upgrade and then keeps paying each month as your utility bill drops. Let's talk hiring and where the work lives. Many regions offer credits for hiring in certain zones or categories, or for relocating operations to targeted areas. Multi-state and multinational businesses can also reduce state or foreign tax by structuring where decisions are made, where intellectual property is owned, and how related parties price services and licenses. This is not about hiding. It's about matching the legal reality to the business reality on purpose. If leadership truly sits in Austin, your minutes, contracts, and bank signatories should say so. If your dev team truly operates in Dublin, your payroll and management should match. When substance and paperwork align, your partner's incentives unlock. When they don't, you get noise instead of money. Credits and deductions are fuel, but timing is your steering wheel. Your silent partner pays more when your rate is higher. That means you plan major deductions and credit-eligible projects with your income arc. If you know a product launch will spike profit in Q4, placing equipment in service before year-end and completing R&D milestones earlier in the year can increase the current year benefit. If you expect a lean year next, you may slow depreciation and push elective spending when the rate climbs again. The same logic applies to capital gains if you're selling assets. A sale on December 29th and a sale on January 2nd can live in different tax years and trigger different partner contributions, even if the cash is similar. None of these moves are stunts. They're calendar choices that convert the rules into margin. Documentation is the boring hero of this entire story. Your partner only wires the money if you can show who, what, when, where, why, and how much. That means invoices that name the thing you bought, payroll registers that show who did the qualified work, contracts that define scope, time records that tie humans to projects, photos or serial numbers for assets, and certification statements for energy gear. If there's a credit form, fill it the way the form expects, and keep the underlying evidence in a single folder labeled with the project name and year. The audit you fear is usually not about whether the rule exists. It's about whether your facts match the rule. Build the facts as you go, and an exam becomes a tour of your good habits. At this point, you might be thinking that all of this requires an army. It doesn't. It requires Cadence. Every month, spend 45 minutes closing your books and tagging anything unusual with a one-line purpose note. New camera for product shoots, in service 0314. Prototype sprints for checkout flow B. Solar array phase 1 commissioned 0622. Every quarter, run a 90-minute projection with your accountant while you still have time to choose. If you're ahead, decide which purchases or projects to accelerate. If you're behind, don't create deductions you don't need. Lock your capitalization threshold in writing once a year. Revisit where your people are and register in states or countries where you've created a taxable presence, because penalties for denial cost more than filing where you actually operate. That rhythm, monthly notes, quarterly forecasts, annual policy, turns taxes from a cliff into a staircase. Let's make this painfully concrete. Imagine a creative studio at $4 million in revenue, $600,000 in pre-tax profit, paying around 30% in combined taxes. Over 12 months, they do 6 ordinary things on purpose. They adopt a written capitalization policy and expense small tools immediately while putting larger rigs into service before year-end, creating a meaningful current year deduction that drops their effective rate a few points. They formalize their R&D notes for a genuinely uncertain internal tool, tag engineering time properly, and claim a credit that directly reduces tax instead of only reducing income. They implement a group health plan structured to qualify for the small employer credit in their jurisdiction and collect the broker invoices that program requires. They replace failing HVAC with qualifying high-efficiency units, keep the manufacturer's certificate, and capture a credit at filing. They run a Q3 projection with their accountant and bring forward training they were already planning into the high-income year. And they clean up their state footprint as remote employees multiply, which doesn't feel like savings until you price the penalties they never incur. In a year, without selling a single extra project, their effective tax rate falls by several points, and their cash pile rises. The silent partner didn't do them a favor, They claim the funding that was in the term sheet all along. There are caution lights. Credits attract attention because they're valuable. If you're claiming one, assume someone will ask you to prove it a year or two from now. That means don't stretch definitions. Don't mass-produce boilerplate memos after the fact, and don't outsource your brain. Your advisors can structure and guide. Only you can supply the truth of how your team actually worked. Be especially careful with programs that exploded in popularity and fraud. The government will claw back abusive claims with interest and penalties, and sometimes with names printed online. The clean wins live in the ordinary. Equipment you truly use, development you truly performed, benefits you truly provide, energy gear that's truly installed, and training you truly delivered. Ownership and compensation matter more than most founders expect. The way owners get paid, salary, dividends, distributions, option exercises, changes which taxes apply and which credits you can use. If you switch from a sole proprietorship to a structure that splits reasonable salary from profit distributions where allowed, you may free cash for retirement plans that create deductions now and long-term deferral later. If you grant equity, a simple election at the right time can convert future upside from ordinary rates to capital gains-like treatment, which is your silent partner agreeing to a friendlier split on tomorrow's win. None of this is one size fits all, and it must be designed around where you operate, who your investors are, and what exit you're aiming for. But the theme holds. The partner pays more when the facts are tidy. If you sell across borders or hold inventory, invite your logistics lead to this party. Customs, VAT, and sales tax interplay with income tax in surprising ways. Storing stock in new states or countries can create filing obligations long before you see a profit there. On the flip side, many regions offer investment incentives or accelerated relief when you put a facility or fulfillment node in service. Model footprints before you sign leases so your partner's contributions offset the real costs, and line up registration timelines with reality. That kind of planning is not glamorous. It keeps five-figure mistakes out of your inbox. The mindset shift is the real payoff. You're not begging the government to be nice. You're treating the law as it's written. A contract that says, if you invest in productive assets, innovate, upskill, insure your team, and use cleaner energy, we'll subsidize the effort. You still pay tax, because paying tax is the membership fee for operating in a functioning market. But you pay only what you owe after you've collected every dollar the partner agreed to contribute.